On January 1st, 2020, Maui Corp, which uses IFRS, signs a 10-year non-cancelable lease agreement to lease a specialty condo from Hula Inc. The following information concerns the lease agreement. The agreement requires equal rental payments of $73,580 beginning on January 1st, 2020. The condo's fair value on January 1st, 2020 is $450,000. The condo has an estimated economic life of 12 years with an unguaranteed residual value of $12,000. Maui Corp depreciates similar equipment using the straight line method. The lease is non-renewable. At the termination of the lease, the condo reverts to the lessor. Maui's incremental borrowing rate is 12% per year. The lessor's implicit rate is not known by Maui Corp. The yearly rental payment includes $2,470.29 of executory costs related to insurance on the condo. And we're asked to, using whichever way we want, calculate the amount of the right of use asset and lease liability and prepare the initial entry to reflect the signing of the agreement. Okay, so the first thing that we're going to do is we are going to figure out the lease payments. So the lease payments right now are $73,580. So let's make a list here. So the first thing we're going to do is we need to calculate the present value of the minimum lease payments. Okay, we know we're under IFRS, so we don't need to go through the ASPE capitalization criteria because we've already been told we're under IFRS. So we know we have a right of use asset. We've been asked to calculate it. We need to calculate the present value of the lease payments. Now, we need to make sure we exclude the executory cost from our annual payments, because we don't include executory costs in the calculation of our minimum payments. So when we're going to put the inputs into our financial calculator, we don't want those executory costs to be included. So payment including executory costs are going to be, up here it says $73,580. Okay, so that includes it. Now the executory costs for insurance are going to be, it says they're going to be $2,470.29. So $2,470.29. So the payment, the lease payment without the exec costs is going to be these two items. It's going to be $71,109.71. And this is the input into our present value payments, input as our PMT for PV. Okay, now we're still going to need to make sure we record the journal entries for the executory costs, which is a separate issue. But for right now, the input into our present value needs to be the payment net of the executory costs. Okay, so what else do we have here? So we've got, now what are we going to do about this interest rate? It's a really interesting one. So it says Maui's incremental borrowing rate is 12% per year. The lessor's implicit rate is not known by Maui Corp, but we know that the implicit rate is required by IFRS, and that's what we're using here. So what are we going to do? Well, we're going to work with what we have. We only have the incremental borrowing rate. And if there hasn't been an implicit rate calculation done, then we are going to use the incremental borrowing rate. So we're going to use this 12% as our I. So let's calculate the present value. So we've got N is going to equal, how many years is this lease? Requires equal rental payments. Where does it say the term? Oh, it's a 10-year. Maui Corporate uses IFRS signed a 10-year non-cancelable rate. So we've got N is 10. We've got, sorry, yeah, N is 10. I is going to be the rate of 12% that we're given. Our payment is going to be what we calculated above, which is 71,109, 71,109, 71. I think I have an extra one in there. Let me just do this. Our payment is going to be this amount here that we calculated, okay? And our future value, is there any guaranteed residual value here or any sort of requirement to make any payments at the end? No, it says there's an unguaranteed residual value of 12,000. So we don't include that into our present value calculations. It says at the termination of the lease, the condo reverts to the lessor. So therefore, there's no future value. So if we go compute present value, we're going to get a present value of 450,000. Whoops, I think I have an extra zero there. 450,000. Okay. So 450,000 then is our present value. So what's our journal entry? Journal entry at the inception of the lease. And of course, we're using IFRS. It's just important to remind ourselves so we're hitting the right account. So we're going to go debit right of use asset, which is going to be for 450,000. We're going to have credit cash because our first rental payment will be due on inception of the lease, which is going to be, our lease payment's going to be this amount. But it's really important now, if we're going to do it this way, to say we have to kind of check for this amount. There's two ways we could do it. We could say the cash is the net amount. And then we could say our lease liability is the balancing figure. This is probably the easier way to do it, in my opinion. And we know we get the right number for our lease liability. And then we need to remember, so journal entry to record the executory costs is going to be debit insurance expense. And it's going to be this number. Let's get rid of the negative. Okay. And then it's going to be credit cash. Okay. And then that's going to be our entry to record the inception of the lease. You could have done these net. We could have said that we could have had the right of use asset, had our lease payment. So we could have had the cash be this amount, but then we'd have to make sure we picked up this executory cost as well in our journal entry. So we'd have a 4-line journal entry, and then we would have the right amount to the lease liability. But because if you pick up this amount as your payment, there's a risk that you're going to end up with the wrong lease liability. I prefer to make them two separate entries. Okay, so let's see what else we have here. So we've got prepare the initial journal entry to reflect the signing of the agreement. So we finished A. B says prepare an amortization schedule for the term of the lease to be used by Maui. Okay, so our lease amortization schedule, let's do that. So our lease amortization schedule. And it's an annuity due basis. You don't have to write that, but I want to keep reminding us that we have to make sure we have that begin function on our financial calculators. So we're going to have date. We're going to have payment. We're going to have interest expense. And we're going to have the amortization. And then we're going to have the carrying value. Okay, so let's talk about these items here. So what is going to go into these columns? So we've got interest expense. So this is going to be our carrying value times our interest rate. This is going to be per the agreement. Okay. because whatever we've said we're going to pay in the lease agreement, that's what the landlord is going to expect. That's what we must pay. This is going to be the amortization of the lease liability, and this is going to be the carrying value. So this agreement was signed on January 1st, 2020. Now, something unique that we have not seen before when we've set up these schedules is that we actually end up with January 1st, 2020 twice. So we copy that line 2 times, and that's because it's the beginning of the year. So we're going to have first we're going to put in the carrying value, and then we're still going to have to make the payment on that date as well. Okay, so the first date goes twice, and then we start doing it regular. So January 1st, 2021, January 1st, 2022, January 1st, 2023, January 1st, 2024. It's a 10-year agreement, so January 1st, 2025, January 1st, 2026. Oops, 2028. Probably have dragged that down, but we only have one more to do, so I'll do it there. Okay, so now we've got our 10 years. You can see here, if we highlight those, I don't have the count on at the bottom, but we've got 10. Our count is 10. Okay, so our carrying value at the beginning, so this is actually our lease liability. It's important to remember that we're amortizing our lease liability, not our right of use asset. That's our depreciation calculation. This is to recognize how we're applying the payments that we make to the lessor, how we apply those to reduce our lease liability. Okay, so because each payment's made of interest and principal, so we need to be able to separate out what the interest expense is versus what the principal reduction is to the lease liability. So our carrying value is what we calculated above. So our lease liability here is going to be, well, technically our lease liability at first is going to be the same as our right of use asset, but then here, this is our first payment. So what we already recognized in this journal entry here. And, you know, personally, I think it's easier to do it this way. Let's just have one line here. Let's do this instead. So we're going to have, so this payment here, if we look at our journal entry on the lease, on the inception of the lease, we're going to have this amount. Our interest expense was 0 because it's on day 1. And our lease amortization is 0. Our lease amortization, so our carrying value is this amount here, 378,890. And that's what we put onto our balance sheet when we first started. Our payment here. So the way that we calculate the amortization is it's the payment minus the interest expense. Minus the interest expense is going to give you your lease amortization. Okay, and that is going to give us our carrying value there. So the way the question has it set up, we'll just do it that way for illustration's sake. Although I do find it a little bit less clear, is because you know how I said we're going to have January 1st, 2020 twice. So here it started it out as the carrying value of the entire amount before we had applied the right of use asset. Because remember how the lease payment, the cash here, is what balanced out our lease liability. Well, here it's like we haven't applied that payment yet. So we're going to have the 450. The first lease payment's going to happen. There's no interest expense because it's day 1. And that's a really important concept to understand. There's no interest expense on the first period. Actually, you know what? I need to move these up. Hang on. Okay, let's move these all up here. Yeah, 450. So then we've got, and then we've got our lease interest expense here is 0. Yes. And then our amortization of that lease interest expense is this amount because it's just simply the difference. You can see it's the lease payment minus the interest expense gives us the amortization. So the way that this is calculated is just like as we thought, we're going to be subtracting the lease amortization from this because our carrying value, our lease liability is decreasing over time. Of course, as we're making more payments, we have less obligation to make payments in the future. Every time we make a payment, that's less payments we need to make in the future under the lease. So our lease liability is decreasing, and it will eventually hit zero when the lease is finished. Okay, so the first period, this interest expense is zero, and that's because this is the first day of the lease, okay? The reason we have 2 here is not because it's beginning of year and end of year, they're both beginning of year, but just so it's the initial carrying value. So I'd put this almost as initial before lease payment or something like that. Because the lease payment is being applied in the second line there. So basically this first line is just saying, well, originally the carrying value without the lease payment would have been 450,000. But once we apply this first lease payment, and of course we have zero interest expense because this is on day 1 of the lease, it just got signed, then our carrying value is 378,890, and that matches right here. Okay, so we're basically saying here the carrying value of the right of use asset was 450, but we applied the lease payment, interest expense of 0 because day 1, then the amortization is the net of the agreement minus the rent payment that we make minus the interest expense. So we reduced our carrying value from the right of use asset down to the 378, which is exactly what we did here. We said we had 450,000, but we had to make this payment, same thing here. So that lease liability on our books on day 1 was the net of the right of use asset and our first rental payment, which is exactly what we're saying here. So what happens next? So just like with a bond schedule, this lease payment is exactly what the agreement states. So this amount's never going to change. Okay, so this is always going to be the same. Now, this needs to say, so this is going to be annual lease payment. And it's really important that we're going to say excludes executory costs. So our executory cost of that 2,000. So looking up here, remember how we had to do this calculation for our lease payment? We said, well, actually per the rental agreement, our lease payment $73,580, but it includes this $2,400 for insurance costs. So therefore our net lease payment per month or per year, is $71,109. Now, when we do our amortization schedule, we are using that net payment. So it does not include executory costs. That wasn't part of the present value, so it would not make sense to include it here. Okay, we're going to need to do a separate journal entry for those executory costs, but they're not included in the amortization schedule or in the present value. So here, our interest expense is going to be the carrying value times our interest rate. And so we were told that the only interest rate that was available is 12%. So that is what we're going to use here. So it's the carrying value times the 12%. Okay, and so you can see the math here. So I've taken the carrying value of the period before times the 12% interest rate, and that's going to give me my interest expense there. And my lease amortization is going to be this amount minus the lease payment minus the interest expense, because this is the interest component. So then this is the principal. So the principal reduction to my lease liability is going to be 25,000. So this is simply going to be our previous carrying value minus the amortization of the principal portion. So my new carrying value is going to be 353,247. And we're basically just going to continue that on. So because I'm in Excel here, I'm just going to drag this formula down. And I'm going to drag this formula down and this one. Okay, and so you can see that each period, I've got my interest expense is going to be 12% times the carrying value of the previous period. And my lease liability amortization is going to be the principal reduction. So in this situation, let's look at this period. So January 2024, January 1st, is I made a lease payment of $71,109, so not including the executory costs. Of that payment, $35,000 of that payment was interest, but $36,000 of it was principal. So I was able to reduce my lease liability by the principal component, which was $36,000, to bring it down to $256,000, my lease liability. And this component is going to go through my income statement as interest expense. Okay, so that is my lease amortization schedule. Let's take a look at what we need to do next. So we did the lease amortization schedule. Now we've got prepare the journal entries on Maui Corp's books to record the payments and expenses related to this lease for the years 2020 and 2021, as well as any adjusting journal entries at its fiscal year ends of 2021 and 2020 and 2021. Maui does not use reversing entries. Okay. So we've got, year-end adjusting entries. So we're going to have January 1st, 2020. So we recorded the lease on the books at January 1st, 2020 right here. So this is January 1st, 2020, but now we're doing December 31st, 2020. So it's the year end of this period. Okay. So let's see what that's going to look like. So we've got this. Now we're going to do the year end. So our year end, we're going to have 2 year end adjusting entries. The first is going to be interest expense on the lease liability. Okay, so, and we can pull this right from our schedule up here. So we've got January 1st, 2020, this amount. Actually, December 31st would be this amount here. December 31st, 2020. Oh yeah, this is January 2021. So we're going to pull amounts from this entry because this is essentially December 31st, 2020. This is January 1st, 2020. I was getting confused because I changed this amount to before the lease rather than having 2 January 1st, 2020s. So this is January 1st, 2021, meaning it's the same as December 31st, 2020. So I'm going to pull the amounts from there. So I'm just going to simply have debit interest expense. Okay, which is going to be here. And my credit is going to be to the lease liability, which is going to be the same amount. Okay, so that's my interest expense. So then I'm going to have my depreciation expense on my right of use asset. So I'm going to have, I've got a right of use asset that I put on the books up here of $450,000. It is a 10-year lease. 10-year lease. So if I take this, 450,000 divided by 10 years, I'm going to get 45,000 per year. So I'm going to have debit depreciation expense. Depreciation expense for 45,000. I'm going to have credit accumulated depreciation right of use asset, which is going to be 45,000. Okay, so those are my entries there. So I'm just looking up at this one. So the 45,000, the interesting thing is that our amortization of the lease liability at January 1st was only 25,000, but we also had the lease payment and how it was applied between the two. So when we book interest expense, it's simply interest expense and the balancing entry goes to lease liability. So we're increasing the lease liability here by 45,466. Okay, so our depreciation expense, we've got that. Then we've got, now what we really need to be careful of, this is super important, don't forget the executory cost entry. This is a super tricky because normally we only have two adjusting entries at year end. We have interest expense and depreciation expense. But when you've separated out executory costs, do not forget your executory cost entry. So we need to recognize that insurance expense. So we're going to have debit insurance expense. And credit cash, which is going to be, so I guess this entry happens at the beginning of the year. Did we have this entry above? Yes, we did right here. Okay. So this is going to be actually part of, forgive me. So these are our 2 year-end entries. Now the executory costs come with the lease payment. So we'll do that on January 1st of the next year. So these are our 2 year-end entries for January 1st, 2020. So let me just see what we had up here. So we're asked to create the journal entries to record the payments and expenses for the years 2020 and 2021. So we need to record on January 2021, we're going to record the lease payment. So we're going to record debit. Lease liability. And credit cash. And this is going to be debit lease liability of 71 of the entire lease payment here. So we're going to say of 71,109 and 71,109 because this is the payment. Okay. And then we've got, we're going to record our executory cost payment. So we're going to have debit insurance expense and credit cash. And it's going to be for the same amount that we had before, which was 2,470.29. So this amount doesn't change. It's simply an amount we pay for insurance every month or every year. And so because we didn't include it in the rent payment, we need to make sure we remember to do that. So we're recording our lease payment, January 2021 lease payment. And this is going to be January 2021 executory payment. Okay. So those are done. So let's just look at what's happened with our lease liability here. So you can see here we've debited the lease liability when we recorded the payment. Okay, so we debited it here. And up here, when we recorded our interest expense, we credited it for 45. So the net of those two entries, so let's just look here. So we've got a credit in the year-end entry, and we've got a debit here of 71,109. So the net of those two things are a net decrease of 25,642, and that is exactly what we have here. So the way that these entries work is that when we make our lease payment, we decrease the lease liability by the entire amount. And when we record our interest expense, we increase it by that amount, and we're going to get to the net amount. So basically what's happening here is when we record lease expense or interest expense, we go debit interest expense, credit lease liability. So here, even though what we want is a lease liability of 0 at the end of the lease, we're actually increasing the lease liability. It's a credit balance, so crediting it increases it, which is kind of counterintuitive here. So when we record interest expense, we go debit interest expense, credit lease liability. Now, when we make our lease payment, we go debit lease liability, credit cash. So so this is decreasing it and this is increasing it. And the net of the two is going to give us this amortization of our amortization schedule of 25,642. So the difference is we don't actually pick off the interest expense from here like we do for bonds, where we'd say, okay, well, this is the interest expense and here's the amortization. It doesn't work quite like that, but this is how the lease will amortize down, and we will end up with these net amounts. It's just that they happen through journal entries of different amounts. So we've got this 45,466. And here's our increase of the 71,109. So you can see how this amount minus this amount gives us this, because this is going to be a credit, this is going to be a debit, so we're going to end up at this amount. I hope that makes sense. Okay, so we did the executory cost payment. Now we're going to do our year-end adjusting entries. Year-end adjusting entries, December 31st, 2021. So we're going to have one interest expense on the lease liability, which is going to be debit interest expense, credit lease liability, lease liability. Okay, and this amount is going to be the interest on this amount, which is going to be 42,389, which is right here, because it's the carrying value times 10, the interest rate of, I think it's 12%. Yeah, so see how we're right here now. So we're December 31st, 2021, which is essentially January 1st, 2022. You can see how there's only a day difference. So this is the interest expense that we're picking up each year. Okay, at the end of each year. And then our second entry is going to be depreciation expense on the right of use asset, which is going to be the same every period. So we're going to have debit, depreciation expense, credit, accumulated depreciation, right of use asset. And this is going to be the same amount we had before. So it's going to be the 450 divided by 10, so 45,000. Yeah, because this is simply straight line, so it doesn't change each period for the right of use. So the right of use is quite simple, because it's simply our $450,000 lease divided by 10 years, whereas it's the interest expense on the lease liability where we need this amortization schedule, because we need the carrying value times 12% to get the interest expense. We need to make sure we've got these net numbers flowing through. Okay, so we finished that one off. Let's see what else we have to do in this very long question. The last one says, prepare Maui Corp's required note disclosure on the lease for the fiscal year ended December 31st, 2021. Okay, so this is an interesting one. So D is going to be required note disclosure. Disclosure for year ended December 31st, 2021. Okay, so we haven't really looked at this before. And what's required in the note disclosure is a schedule of future lease payments under the contract. And this contract expires 2029. And we also need to show the balance of the lease liability. So let's take a look at what this looks like. So year ending December 31st. So we're going to have the different years here. So we're going to have, so this is ending 2021. So we're only looking for future payments. So we've got 2021, 2023, 2024, 2025. Remember, this lease expires in 2029, right? Up here on our thing, we've got the last one is January 1st, 2029. So 2025, 2026, 2027. So we only need to do, how many periods is this? 5. So anything beyond 5 years, we can group together under the note disclosure requirements. If this is seeming news to you, it should be new. We didn't cover this in the lecture. So 2027 and beyond, okay, is going to be our last one. So how are we going to get the amounts for these? So we're going to have here, we're going to have total lease payments and less the amount representing executory costs. Okay, so let's see what we've got here. Let's make this bigger. Okay, so in 2022, what is the balance of our lease payments? Well, we know our lease payments each year are going to be, now there is a major difference in this note disclosure. It includes executory lease payments, include executory costs. And you can see that then we show the amount that represents executory costs down here, okay? So we won't be able to take the lease payments from our amortization schedule because remember, these are not including the executory cost. So we're gonna take the lease payments. Now, luckily we only have one lease. It gets more complicated, of course, when companies have lots of leases, but we have one lease and this is what the payment was before we took out the executory cost. Remember, it was $73,580 per year. So we know we're going to owe this in this year, each of these years. Whoops, let me just fix that. Sorry. So we're going to go, hang on. Put these down here. So this is going to be our payment each period. 73,580. And then here we've got 2027, 2028, 2029. So we've got 3 years. So we're going to say this times 3. Okay. And that's going to give us 227.40. And that's because we've got 3 years here, 2027, 2028, and 2029, which is when the lease ends. So our total lease payments, which is simply going to be our sum under this agreement, is going to be 588,640. And the amount that represents executory costs, which is going to be, how many years do we have here? So we've got 3, 4, 5, 6, 7, 8, because 2 years have passed. So we're going to go up here and find our executory cost amount, make it negative, make it positive, sorry, and then multiply it by 8. So the amount that represents executory costs is $19,762. So our net payment, our net lease payments are going to be 588 minus the executory costs, 568. And then we're going to have, so 12% interest. I just see here. Then we're going to take out the interest at 12%. Let me just see what that number is. Nope. 12% interest. What do we have here? So what's our total interest expense? 261. But because we're only looking from January 2022, 215,630. So our interest expense is going to come from this schedule. But we're only looking at January 22 because remember, this schedule in our notes is only for future lease payments, and we're starting it for January 2022. So 215,630 is going to be our interest expense. Representing. So I'm going to put the interest expense, the total interest expense from our schedule up here going forward. Okay. So that's going to go through our income statement. So it's not really part of our lease our lease payments, if you will, because that's the interest component, not the principal. So the balance of our lease liability in the future, this is our future lease liability, is going to be this amount minus the interest here. So it's going to be 353,247. Okay, we just did some pretty crazy stuff. So let's talk about what happened here. Okay, so year-end disclosure. What we have to disclose is what we've committed to in the future. So this note disclosure is for December 31st, 2021. We would have already made our 2021 lease payment because it was due on January 1st. So the next lease payment that we're capturing here is January 1st, 2022. So in our notes for both IFRS and ASPE, we're required to disclose our commitments. So here we've got the 2022 payment. So this is the full lease payment, including executory costs, and that's really important to realize. So this is what we've committed to. We've said we'll pay this. We've said we'll pay this. These are our commitments. And what the notes require you to do is show 5 years separately, and then to show anything beyond 5 years grouped as the next year and beyond, because this lease for all this note knows it could be 20 years. They don't want to show some crazy schedule. So past 5 years, you group it. So we've got 3 years grouped in here, 2027, 2028, and 2029. So this is simply the same payment per year times 3 years, because we've got 3 years in there. Then all we've done is say our total lease payments, which is simply the sum of everything above. Then, as we said, this includes executory costs. So we're going to show what the amount is that includes executory costs, so we can show what we've actually committed to for the premises itself. So the executory costs are the amount we had agreed to for executory costs, which was this amount here, 247,029. And this is simply times, times 8 years, because it's a 10-year lease, but 2 years have passed now that we're in essentially 2022. That gives us a net. So all we've done is say our total lease payments less our executory costs over 8 years gives us our net. Then here, what we've done is we've said, well, in terms of what our lease liability is that we expect is we're going to take out the amount that we're going to have in interest of this lease liability. Even though the interest isn't included in this, these are simply payments per the contract. We are going to take out the amount representing the 12% interest. Why 12%? Because that's the interest rate that we're using as the implicit or the incremental rate. And our total interest expense here is $215,630. And you can see actually here, this total is the same total as our lease payment commitment, $568,877. So here's our it should be this $578,677, which if you added these two things, we should get to that. Oh, it's because I picked up all the periods here. Just a sec. Let me just adjust that. So from here, yeah, 568,877. Okay, let's check something quickly. I see. It's because here we had an extra lease payment. How many years do we have here? Okay. So then basically here we get to the interest expense, which was this amount, and then the balance of our lease liability is the net of the total lease payments less the executory costs. And then if we take off the interest expense that will incur over the 8 years, then the balance of our lease liability is shown here as $353,247. And that takes us through this question.